Welcome. Have you ever looked at your paycheck, seen that chunk of money missing, and felt like you were trying to solve a puzzle with half the pieces gone? Well, today, we're giving you the blueprint. Think of this as more than just a tax explainer. It's a strategic briefing designed to give you a really clear, high level understanding of the entire income tax system. We're going from the core purpose all the way to how it's actually applied.
All right, let's jump right in. We've broken this down into 5 logical parts. First, we'll hit the foundational why. What's the whole point of this system? Then we'll get into the who and the what, who's paying and what's being taxed. After that, we're popping the hood on the how, the real calculation engine. Then comes the fun part, the strategic how-to for reducing your bill. And finally, we'll cover the where, that whole other layer of state taxes. This is our roadmap. Let's get started.
So, first things first, before we get into any of the numbers or the forms, we have to understand the core principle. What is the fundamental reason for this entire system? Why does income tax even exist in the first place?
At its heart, it's actually pretty simple. Income tax is just the main way the government collects money from what people and companies earn. You can think of it as the financial engine that keeps all public operations running. And where does all that money go? Well, think of it as a giant national investment portfolio. This is what funds everything from the roads we drive on, to the schools our kids go to our national defense and crucial safety nets like Social Security. It's basically the funding mechanism for our entire shared society.
What's really interesting is that this whole system we deal with every year is actually a pretty modern invention. The very first income tax was just a temporary measure, to pay for the Civil War. It wasn't until 1913 that the permanent system we know today, along with the infamous Form 1040, was actually put into place.
Okay, let's move on to our next section. Now that we've got the why down, let's figure out the who and the what. Specifically, who is paying these taxes and what kind of income is actually taxed.
So this is a really crucial point. Not everybody pays the same rate. The U.S. system is what's called progressive, and the idea behind it is simple. The more money you make, the higher your tax rate becomes. The thinking is that people with higher incomes can afford to contribute a larger percentage. This chart shows that tiered system perfectly. And here's something critical to understand. If you move into a higher tax bracket, it does not mean all of your income is now taxed at that higher rate. No way. It only applies to the money you earn inside that specific bracket. It's a marginal system. Right now, those rates go from a floor of 10% all the way up to a ceiling of 37% for the highest earners. The system also splits taxpayers into 2 big buckets. On one side, you've got individuals, people paying taxes on their salaries and wages. And on the other side, you've got businesses. That could be anything from a huge corporation to a self-employed contractor, paying taxes on their profits. All right, we've covered the basic framework and who the players are. Now let's pop the hood and really look at the calculation engine itself. How do we get from your gross pay to what you actually owe in taxes? Let's map out the process. Looking at it from 30,000 feet, it's really a 4-step process. First, you add up all your income. Second, you make some specific adjustments to get to something called your adjusted gross income, or AGI. Third, you subtract out your deductions. And only then, at the very end, do you apply those tax rates to what's left. Okay, let's zoom in on that second step. Adjusted gross income, AGI, is arguably the most important number on your entire tax return. It's your total income minus a few specific things. And why is it so critical? Because your AGI is the key that unlocks or locks your eligibility for a ton of the deductions and credits we're going to talk about in a minute. It's the real starting line. And the IRS itself tells us exactly what comes next. Once you have your AGI, you subtract your deductions. This is the step that actually shrinks your income before any tax rates get applied. The number you're left with is your taxable income, and that's the number that really matters. This brings us to the most strategic parts of this whole briefing. Now that we see how the engine works, let's look at the tools you can actually use, the levers you can pull to legally and effectively lower your tax bill. This right here is probably the most important thing to understand for smart tax planning. The difference between a deduction and a credit. They both help you, but they work in totally different ways. A deduction lowers your taxable income. It shrinks the amount of money the government can tax in the first place. A credit, on the other hand, is way more powerful. It's a dollar-for-dollar discount off your final tax bill. Let's just run a quick example. Say you make $100,000 and you get a $20,000 deduction. That drops your taxable income down to $80,000. So that $20,000 is shielded from taxes.
but the actual cash value of that deduction depends on your tax bracket. If you're in the 22% bracket, that $20,000 deduction saves you $4,400. Now, let's compare that to a credit. Let's say your final tax bill comes out to $20,000. Well, a $4,500 tax credit is basically like having a gift card to the IRS. It directly wipes out $4,500 of what you owe, bringing your final bill down to $15,500. See the difference? A credit's value doesn't change based on your bracket. A dollar is always a dollar, which makes credits incredibly valuable. Okay, for our final piece of the puzzle, we have to add one more layer of complexity: geography. Because after you figure out everything with the federal government, you still have to deal with state income tax. So let's take a look at the where. What do you think this number is? This is the number of states in the US that currently have no personal income tax at all. 0. So if you live in one of these states, this whole part of the equation gets a lot simpler. And here's the list. You've got Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. All of these states have decided not to tax individual income. But that's not quite the whole story. And here's the crucial thing to remember. Those states still need to pay for schools and roads, right? They have to get that revenue from somewhere. So what they often do is make up for it with other kinds of taxes, like higher property taxes, or in places like Florida and Tennessee, a higher sales tax. It's never a question of if you'll be taxed, it's just a question of how. It's a big strategic trade-off. And really, that brings us to the final takeaway from this whole briefing. To really get a handle on your finances, you can't just look at one piece of the puzzle. You have to understand the entire framework, how federal, state, and even local taxes all fit together. You need that complete picture to do any effective planning. So we've just built the complete framework, from the why all the way to the where. The next step is really up to you. With this new perspective, the next time you look at your pay stub or think about your finances, what's one new question you're going to ask? Because that's where true understanding really begins.